Hello, everyone. Welcome to Stocks That Can Double series, stock number 10. Now, previously, I've done 9 videos on stocks that could double, and this is the 10th. So, if you're interested to know those stocks, please check the Stocks That Could Double playlist on this channel. I want to clarify this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts on stocks that I think that can double in the next few years. Please do not buy this stock because of this video. Please do your own due diligence. Guys, make sure to smash that like button, subscribe to the channel, and let's continue growing together. Now, the stock that I'm going to talk about is Chipotle. It's currently trading at $32. Chipotle stock is down 47% year to date. It has a market cap of $42 billion with a PE ratio of 28. Now, previously, we've done a video when it was trading at $56. In that video, we said the risk reward is not good. The 5-year gain was 27%, which will underperform the market. Now, if you had watched that video and did not buy at $56, you have made a good decision. Now, before I walk you through the 5 filters, let me show you the main reason why Chipotle stock is down big this year. The main reason, in my opinion, is the earnings miss. Same-store sales are they're an important metric for restaurant businesses. They grew only 0.3% compared to 6% previous year. This is a big concern as growth has slowed down massively. Chipotle is saying young customers are eating at home more and visiting Chipotle less due to unemployment and inflation. Margins are also under pressure as operating margins are down by 1%. Now, let me walk you through the 5 filters. First one is value proposition. We all know the business model of Chipotle, and a lot of people eat at Chipotle for lunch or dinner. So I'm not going to repeat the value proposition. The second filter is margins. Restaurant businesses historically have lower margins. Chipotle's recent operating margin is close to 16%, so the net margin would be a bit lower at 13 to 14%. The third filter is balance sheet. Chipotle has close to $1.4 billion of cash equivalents, short-term investments. The total debt is $4.9 billion. This seems like a really bad situation as the debt is significantly higher than the cash, but this debt is not bad debt. Most of this is long-term leases, which count as debt, so the balance sheet is good. The fourth filter is growth potential. The restaurant business growth when their existing store sales grow and when they open up new stores. We know some same-store sales are struggling a bit to grow now, so Chipotle is planning to open 315 to 345 stores in 2025, 350 to 370 stores in 2026, including 10 to 15 international locations. So there is growth potential. Now, since Chipotle is profitable, they can potentially open new stores with their profit. Currently, they're making close to $1.3 billion in profit, so they can use that money to fund growth. The fifth filter is valuation. The revenue expectation is $20 billion by 2030 from $11.6 billion in 2025. This assumes close to 10% annual growth. In the most recent quarter, they grew by 7.5%. So this seems like a stretch to me. But we assume that they can get to $20 billion by store expansion, menu innovation, digital sales, and more. Let me now show you the valuation. I assumed a net margin of 14% based on the operating margin of 16%. I applied a 30 multiple. Now, they don't dilute shareholders significantly, so I kept the share count consistent. Overall, I expect a $64 stock price by 2030, which is a double from the current price of $32. Now, as you all know, usually my target price hits within 3 years from the date that I do the valuation because I am conservative with my valuation. But in any case, I think that Chipotle is a 2x opportunity in the next few years. What do you guys think? Let me know your thoughts in the comments, and thank you so much for watching.